So is this the right reaction, both the fiscal and the monetary reaction, to saying, OK, we're not going to react this time? Obviously, Jay Powell is looking at this differently because he thinks at this point it could really spike inflation if we react the same way we did in the past, that this is more problematic, which means you're not going to get the same playbook.
So it's certainly the right monetary policy reaction because we have inflation that's proven to be higher and more persistent than many expected. And it's very difficult for the central banks to remain in uber stimulative mode when inflation is an issue. On the fiscal side, that's a political issue, and you've been talking about it all morning. That's really a political issue. My view, and I know that not everybody agrees with this, is that the soft infrastructure is as important as the hard infrastructure in order to increase labor force participation, in order to increase the supply responsiveness and productivity of the economy. But that's become irrelevant because of the politics.
Joe brought up the point that maybe BBB becomes PPP. You think that's an option, or have we just tapped ourselves out with this?
Yeah, I don't think we're going to see much more fiscal and monetary action going forward. And I think the marketplace has to get used to this. It was easy to put aside all the economic concerns, all the COVID concerns, all the geopolitical concerns, because we had almost guaranteed injections of liquidity. They were massive and they were predictable. What is changing is you can no longer bet on that. And now the market has to realize that they have to price in fundamentals and they have to differentiate much more between names. So this is going to be a very different year, 2022, than 2021 was.
Meaning you can't count on all the same old things, that you should buy every dip, that there is no alternative. What does that mean for investors?
So that's going to be what's going to be tested, is do you still have that conditioning when you don't have the support of predictable injections that help push the everything rally? That's the big test as to whether the conditioning will persist. It is already weaker. We see this in how the market has been behaving. And it's understandable because the Fed is no longer there because of inflation.
The tech stocks are getting hit pretty hard today. They've been the ones that have been punished the most. Last week, the NASDAQ was down 3%. It was the biggest decliner. Is that the right play? Are they the ones who should be getting punished in this environment? Or should it be more the tourism stocks, the airlines, places where if you get hit hard and there's nobody to back you up, how big of a problem is that?
So from a fundamental perspective, it shouldn't be the tech stocks. Okay, they are most immune to both the demand side, lower demand, and also they're immune to the supply disruption and inflation. So it shouldn't be them, but the trouble is where they are starting from and the extent to which they have outperformed over the last couple of years. And what we have seen happening, it started small, but it's starting to build, that where there was a lot of froth, that has tended to come off first. So I think it's just a technical adjustment, but fundamentally, the tech stocks are in a better place to navigate the next few months than travel, for example, leisure. That's going to get hit.
Mohamed, Goldman Sachs is lowering its GDP expectations for the first quarter based on the idea that BBB is not going to, the Build Back Better bill is not going to get passed. What do you think happens to the economy in the near future, let's say the first quarter, maybe the first half, and what do you think happens to the consumer?
So the underlying strength of the economy is still considerable. Balance sheets are still healthy. And that's because we transferred 15 to 16% of GDP from the government to households. That's an enormous buffer, but it's being eroded. I think the big risk is not an internal weakening of the economy. It's a policy mistake. And the markets are worrying more about particularly a monetary policy mistake. So, left to its own, the economy can navigate Omicron because it has quite a bit of internal momentum. What it cannot navigate is Omicron plus a policy mistake.
Shepard Smith here. Thanks for watching CNBC on YouTube.